Hey everybody, welcome to another free edition of our Trader User Group Weekly Roundup for the trading week ending August 2nd, 2019. I'm Preston Brent, and I hope you're all enjoying the hot, lazy days of summer as they kind of come to a close. Moving kind of quick, I think. This past week's theme is it's Shark Week, not only for the Discovery Channel, but clearly for the markets. You know, Jaws is still alive and well, it seems. All indexes across the U.S. plundered. The Dow was down 2.6%. S&P over 3%, 3.1, I believe. NASDAQ was almost 4%. It was down 3.92 for the week. And the Russell was down 2.87. We also saw volatility come back into play again. It was up about 40, almost 45% for the week. It finished at 17.61, the VIX. Last week it was down at a comfortable 12.16. But the world markets didn't go unnoticed either. The FTSE over in London was down 1.88%. The CAC 40 in France was down almost 4.5%. DAX almost 4.5%. Japanese market, the Nikkei was down over 2.6%. And China was down about 2.6%. Now this week, the best performing sector, just barely up in the green, 25 basis points, was the utility sector, while the worst, of course, was the tech sector. It was down over 4.6%. So markets didn't fare very well this week. The some more market stats for you guys. The trailing prior 12-month PE ratio is at 22.41, and the forward PE ratio is about 17.72. So the forward PE is lower than the trailing by about 25%. So it shows that the markets have discounted from the prior 12 months to the go forward basis by 25%, right? They're still a little bit elevated over the 5-year average, but they've discounted it a pretty good bit, you know. The other thing that I see here is the S&P annual dividend yield is about 1.91%. And the 10-year interest rate this week finished at a low, you know, a low that was around the lows when Trump got elected in 2016. It finished at 1.85% for the 10 years. So the dividend yield is greater than the interest rate. So that does tend to attract capital into the equity markets, which, you know, builds a little bit more of a bubble. Okay. I still think we have a ways to go a little bit higher, but not without the proverbial pullback. But anytime you get a dividend yield higher than the interest rates, then clearly money is going to be seeking dividend-paying stocks and equities, which will kind of prop it up, I believe. So, like I said, this past week we had a very interesting trading week. I saw there was a negative reaction to Jerome Power Ranger Boom Boom Powell's 25 basis point rate cut. And basically, and I was watching price action very closely. When the policy statement came out at 2 o'clock Eastern Standard Time, markets didn't really move. I mean, we were right around flatline. And then when he started his press conference, confusion followed and the markets fell dramatically. But that should not be a surprise. And I keep telling our members, of the past 11 public statements Powell has made when he gets out in front of public and talks like this, um, only 2 times have the markets gone up. The rest of the time they go down. So he's batting about 81% that the markets fall after he speaks because he doesn't really use his words very carefully. So it's a good bet just to put on a couple of puts right before he bellies up to the podium, so to speak, to talk. But what was really interesting, and yeah, we did have rates move down a little bit when they cut the rates by 25 basis points. But the very next day, on Thursday, when it looked like the markets had recovered that drop from Powell's speech, Trump comes out with a tweet, you know, imposing an additional 10% trade tariffs on the remaining roughly 350 billion in Chinese imports to start September 1st. So the markets immediately sold off again. And Trump's tweet, by the way, it resulted in the S&P and NASDAQ turning in their worst weekly performance so far this year in 2019. But what I found interesting was Trump's tweet caused the markets, the interest rates to move lower than the rate cut of 25 basis points. So Trump, I guess, is going to get his low rates, whether Jerome Boom Boom Powell puts them out there or he does them via his Trump tweets, okay? But again, I find, and I saw some stats in Barron, which was really interesting, Barron's this weekend's magazine, that it seems like every time the markets hit a peak, right? We've seen them sell off based on a Trump tweet on imposing more tariffs. We saw it in January 2018 when we had a peak, and then out comes these tariff issues, and the markets sell off dramatically. And that was the first time, and that was the worst sell off we've had in quite some time. Then we saw it again after the markets came back up and took out the January 18 peak, and then we had the September 2018 peak, and then out comes more Trump tweets on China, and then the markets gave us the Q4, which is pretty ugly. And then even in May, this May 2019, when the markets pulled back about 5 to 7%, it was preceded by a Trump tweet. And then again, this past week, we were near all-time highs, and then the S&P near the peaks, and Trump comes out with his another tweet on China. So it's just another Trump missive around peak. So maybe this guy, Trump, is really a trader at heart and he's playing the markets like a pro, but who knows, but it does cause all the rest of us to be a little bit cautious as we move a little bit higher market wise, because all it takes is a tweet. I had a lot of members that were in our chat room that, took an hour break or so after the markets were moving up on Thursday really nicely. And then we had a 600-point reversal in the Dow, within an hour or two after the Trump tweet hit the markets. It's just really amazing. And it took about 5 or 10 minutes after the market started moving lower to kind of realize just what the heck it was. Okay. Now, the other thing that we saw this past week, U.S. interest rates moved lower in the combination of the Fed rate cut of 25 bips and the Trump tweet. This year, or this week rather, it was the biggest 1-week decline in our 10-year interest rates going back 7 years. I mean, the 10-year fell 21.7 bips. All right, that's 21.71%. That's huge. Almost a quarter percentage point move lower on the 10-year, and we're sitting close to the lows in interest rates around when the time Trump was elected in November 2016. So we're seeing also in the Fed fund futures almost 100% probability. I think it's like 99.6% probability of another 25 bip rate cut in September 17-18 meeting. And then, not surprisingly, over a 75% chance of another rate cut on top of that in the December meeting. So the markets after this past week have improved and increased their odds of a total of 3 rate cuts this year prior to this week. So the markets are clearly pricing this in, and we're seeing this globally. I mean, globally, it never ceases to amaze me just how low government debt can go. Remember, there's over 13 trillion. It's probably going to go up even more than that after this past week once the data is collected and assimilated and reported on. But there was over 13 trillion in negative yielding debt. And we just got word that Europe over the past week or two moved ahead of Japan for holding the most negative yielding debt. So it's not a first prize you want to be in or first place you want to be in. But globally, all central banks are kind of racing to the bottom, and that's pissing off Trump because it reduces their currency. And where else is money going to go? It's going to come here to the U.S. because we're still, even at 1.85%, I think, for the 10-year, we're still much higher than most other G7 countries or even G20, really. From a risk reward standpoint, so money is just pouring into here, so that has a tendency to strengthen our dollar, lower our interest rates, really dramatically. Now, all of this is going to come undone sometime over the next 2 to 5 years. A lot of people are, generally it's times like this when my inbox is just flooded with gloom and doom. Okay. I'm still a believer in the markets moving a little bit higher because there's really no other place for money to go except for cash. So with that dividend yield being higher in the S&P than the 10-year interest rate, it will force more money into the equity markets in search of yield. I mean, it's just the law of the way capitalism works and the way money works. So it's going to have a tendency to push equities up higher, which is going to set us up for a bigger fall sometime in the future, but just not yet. I'm still on record as saying we'll probably run up to 31, maybe even 3,200, but not without the requisite 5 to maybe 10% correction or a 5% to 10% pullback, right? Or even a dip, which I define as less than 5%. The other thing I saw this past week on the import data, it is showing that the tariffs on China are having an effect because our imports year over year decreased from China by 12.6% from June of last year to June of this year. So that is having a shift, but the suppliers and the complex supply chains that companies are trying to piece together are moving to other countries like South Korea, Taiwan, Vietnam, those kind of things. And we've seen imports from those countries increase by 9.2% year over year. So we're seeing a lot of large companies moving out of China and reestablishing some of these supply chains that have been built over decades. It's not going to happen overnight. But I believe over the next 3 to 5 years, you're going to see a dramatic shift in imports from China versus some of these other countries. Okay. And that is the Trump effect. And I'm all in support of it. I believe that that's something that needs to happen. Because if you've ever done business in China, they do copy IP. And they've been able to move forward very rapidly in technology gains and a few things like that, even operational sophistication of corporations, supply chain, administrative, and everything else just by copying our stuff, because you can't do business over in China and go after their population without turning over your IP, right? They copy it, and they cut you off in the knees, and then they just take your IP. So a little bit of greed on the U.S. corporations' part have fostered this over the past 2 or 3 decades. But I think this is the right move. But short term, it's going to be a little bit painful to really hit. Okay, the one thing that's keeping the U.S. markets really going fairly strong right now is the consumer. You got employment; it's still at 3.7%. The jobs data came in fairly strong. I mean, it was at expectations, granted, but the consumer is still spending. Retail sales are up. And it is keeping the markets buoyant here. Everybody wants to sell to the U.S. consumer. So that is an advantage that Trump is really playing out. What you see on the screen right now is the daily chart of the E-mini futures, but it is on an Ichimoku chart. You can see we came right down, as I was telling our members here. We put on some bearish hedges right up in this area here. It's an Elliott wave 5 up. You can see the 3, 4, 5. Typically after an Elliott wave 5, you get an ABC pattern or a minor 1, 2, 3, 4, 5 pattern, but you get a reversal in trend, the 5 leg being the last leg of a longer trend, and then you kind of reverse and then you start to pick it back up again. You can see the green cloud below that suggests that's where all the support is. Should we go down that low? These are key support levels. This key support level here of 29.1321 comes in line with a fib node pullback, a 38 percentile pullback of 29.13. So they're almost sitting right on top of each other. In fact, if I were to just pop the fib node on real quick, you can see here over on the right-hand corner, the 38 percentile pullback is almost sitting right on, surprisingly or not surprisingly, a key price level support action. And then the 23.6 percentile pullback is sitting on another key level. So the fib nodes really work very well, okay? And I don't see us going much lower than the 28.77 level, okay? Which is around a 50 percentile pullback on the fib. If we do go lower than that, then we're going to come back down and we're going to shift the dynamics here a little bit. I do have a value area on the charts, which is where the bulls and the bears are pretty much equal, sitting at 28.85, just north of this area here. So you can see how we're moving through here. And this was also a divergence trade as well. So it's just setting itself up. If I take it out to a weekly chart, we'll step out just a bit, okay? And you take a look at it. You can see that it did set up for a divergence on the weekly, right? I mean, we have a cross here, we have a cross here. You can see the line is clearly down, and we had a high and a higher high, clearly up. So that divergence on a weekly chart typically means that over the next 1 to 3 months, we can see sideways to weakness in the markets, and it's all tying together to come into this range right here. And of course, if this range breaks, we can all the way. Another support level I have is down around 27.50. Okay, which would take us down roughly to the lows that we made in the pullback in May. All right, that would be my line in the sand kind of thing. And then the fundamental dynamics of the market will change if we move lower than that. So you may be asking yourself, what does that mean from a pullback perspective? How does it look? What percentage would that put us in a correction? All of those fun things. So if I were to just come in here and just select the tools or the ruler here and just put it from the high right here, let's just drag it down um, right down in that area right here around 27, right around 2750 area, right in that area here. You can see it's right around a 10% pullback. So that would put us in official correction territory if we come down there. If we come down to the 2746 are the lows that were made from May as we move back up, 9.63%. So that would keep us out of correction territory. So that's the low that I'm defining here. That would give us a pullback. I define pullbacks as between 5 and 10%. Greater than 10%, there's official definition called a correction. And then, of course, greater than 20%, it's a bear market. But you can have a secular bear or you can have a cyclical bear. We had a cyclical bear in Q4, meaning it doesn't last very long. You're generally in and out of it in anywhere from 1 to 4 months. A secular bear market would be like the dot-com bubble or 07 through 09 or 08 through 09, where you're in it for over a year and a half or 2 years. Okay, so you can have cyclical bull bear markets, and then we get out of them. And if we do that, like Q4, I think we'll bounce out of it fairly quickly, at least for the near term. I don't see us moving into a recession. I don't see us moving into a bear market, a secular bear market, until several years out. Okay, although you're seeing the gloom and doom and all the reports and everything like that. Now, if I were to also show you this same chart, but let's do it on a Bollinger Band chart, but I've got three Devs or three standard Dev defined on my Bollinger Band rather than the traditional. Let me find the thing right here. Here we go, right here. So you can see on this Bollinger Band chart, the red lines are 3 standard Dev, purple lines, the traditional 2 standard Dev, and the blue lines 1, and then the yellow is the center of the Bollinger Band. And you can see here, again, same MACD, but you can see the sell-off here, and we actually went below 3 standard Dev. So typically when you get through that area, you're going to see a little bit of a bounce back, right? So, if we do have a bounce back, again, history tends to repeat itself. Human nature tends to repeat itself. So when you have these lows here, that go below the 3 standard Dev, the tendency is to move back up to the 1 standard Dev, or maybe even to the middle of the Bollinger Band. And then there is a gut check. Are we going to go through it, or are we going to roll back over again, right? And then you can see, as a more normalized pullback, you're usually on a 2 standard Dev, because pullbacks can be more aggressive than grinding higher, right? When you grind higher, also a 2 standard Dev, if it's a very strong market, we'll kind of grind between the 2 and 1 standard Dev. That would be between the blue and the purple line. But when you're falling, you're generally on the purple line to slightly below, right? If it's really aggressive, like we had here in May. All right, and then as you can see, as we moved up in June, we're between the blue and the purple. So now we're right back down here again, sitting on the bottom here, and you can see it's very similar to that pattern right there. So, and I've got this 38th percentile right here, sitting at 29.1464, and if you remember on the Fibonacci, it was at 29.14. 21 roughly. So I mean, we're so close, just call it 29.14, sitting at the fib node, sitting right there like that. A pullback down to the 50 percentile right here would give us a 5% now of the fib node. I was telling our members that I was expecting at least a 2.5 to 5% pullback. If we break this level here, then we're going to go for a little bit of a run. Okay, it'll be a little bit of a run down here. And again, the low point that I'm seeing here, that is going to be the solid line in the sand thing. But if we come down just slightly north of that, that'll give us just slightly under a 10% pullback. So this is our field of play right now. And remember, August is traditionally one of the worst trading months of the year for the markets, because everybody's on vacation, liquidity is lower. People are thinking about other things. They leave the junior traders at the desk. Not that they won't trade any better or worse, but they're not making the big moves and the hard money decisions that the big guys are making. So they probably hedged up before the holidays, and they're just kind of taking things easy. Okay, so that's a little bit about what I see across all the markets. I can go across and show you all the major indexes and show you here. If I switch the screen again, and let me just take it over to another view here. Let me just see. Let me find that right here. So what I'm going to go over here now is just a normalized view, a bar chart, not necessarily candles, but you're going to see here the high price here, and then we're off down in this area right here. So it's about a 3.5%, maybe a little bit less pullback from the highs. So we're between my 2.5 to 5% move so far. You can see the 200 or the 50 EMA we're below. I want to see us get back up above it again. To me, the key point higher is going to be around the 2950 to 2960 area. Okay, if we can climb back up above that level and hold it, that will be a good thing. You can see this line. If I were to just draw this line right here, which is at roughly, let's call it 2960, roughly. Okay. I want to see us kind of hold that, and we could also make the argument that we had right at that level there before that thing broke down here, a little bit of a left shoulder, head, right shoulder, but it was not really a true head and shoulders because the right shoulder is higher than the head. But we could draw this trend line like this, right? And say that we broke right in this area here. But all lines ended up to showing that the markets are going to move lower. So we were hedging a number of different ways. I could also take it out to a weekly chart right here on this same thing here and just line up coming all the way back to the January, as I told you prior, that there was a Trump tweet right in this area here. There was a Trump tweet on China right here. There was a Trump tweet on China right here. And now there was one right here. So I don't know if he's doing this on purpose or he's just Machiavellian or he's playing the peaks at the best time to throw these tariffs on because he knows you're going to get a pullback, right? So if I were to connect all the dots in this thing right like this, you've got this line just like this, okay? And that would suggest that we're going to come down in this area, maybe even down here, and then we're going to work our way back up. I'm calling anywhere from 3,100 to 3,200 area. So that would put us out in time, probably towards the end of this year, Q1, Q2, Q3 of next year. But that's kind of where I see us going before we give it up a little bit more severely. Okay. So that's a little bit about what I'm seeing. And by the way, again, these are in all indexes. This isn't just in the E-minis. The only one that's concerning me a little bit here, you can see how we've been making higher highs, right? So the definition of a trend is higher highs, higher lows. And we have had, outside of the Jerome boom Powell mishandled communication in December, which really sold us off here. I basically say the low in December was really met right around the 2630, 2650 area right here. This last gasp down here was a Fed mistake. And then when he admitted it in early January, the markets kind of normalized again. All right. So if you take this little last dip out, we've got lower high or higher lows, higher highs, right? So that's kind of what I'm looking. But now just look at this here, higher highs here. If we come over on the weekly chart and we look at the Russell and we'll look at the RUT, the cash index, you can see here with the RUT, completely different. We're making lower highs. I mean, this is the pair trade here to me is just setting up because it's been like this, for over a year, where the Russell is going to outperform the S&P either to the upside or to the downside, right? So I believe that this thing is going to come unglued here at some point. Not really sure. Either the Russell is going to play catch up. Remember, the Russell is nowhere near its 2018 all-time highs, which was made in early September, by the way. The other indexes didn't make their all-time highs until early October. So they were trailing by 4 or 5 weeks, which is normal, right? But the Russell also leads the market lower. And now we've got this dramatic move here in the Russell, and we have not been able to really move up beyond this right at this point right here. Okay, so this to me is a big, big, fat, unflyable yellow canary in the coal mine, right? I'm going to watch this very closely, very careful, because if we look at the Dow, right? Let me just get the Dow up here. If we look at the Dow futures on the same chart, look, high, higher high, higher high. We get NASDAQ on the same chart. Let me just find it. Where did you go? I know you're on here. Here we go, down here at the bottom. So if we get NASDAQ on the same chart, high, higher high, higher high, higher high, right? Same MACD divergence. This is going to suggest weakness in technology coming up over the next couple of months until we get through September, October timeframe for the Q4 finish. So I would not want to be going long on this initial dip in technology. I would want to just take a little bit of chips and profits off the table. If you do get a rise up, it won't be the fangs. I think it'll be, in fact, I think some of the fangs are worthy of maybe just picking up a couple of puts in them near term, right? I just think the odds favor it coming back. We can have a bounce higher. We may have an inside day, so an inside day is markets moving within the weekly bar here. So we're an inside day or two, and then we give it back up again. Okay. If we look at the weekly chart of NASDAQ, I'm sorry, the daily chart, you can see we're well below the 50 EMA. Right? Here is the 50 EMA here. Here's NASDAQ well below. You can see the value area where the bulls and the bears were equal over the past quarter, sitting way down here at 73.61. If we look at the E-minis, S&P 500, the value area is sitting below the price action at 28.84. Okay, and if we look at the Dow on the daily chart, you can see we've got one value area we sit on for a day, and this is kind of what's kind of holding the glue here. And then there's a lot of support here because there's very low volume. And then this yellow bar here is where the greatest volume took place in a value area here. So we're kind of like in these alligator jaws where I think it's going to serve as support here because there's not a lot of buyers or sellers in this area here. So there's no reason to sell down in this area unless it's what I would call forced selling. And I don't think there's going to be a lot of forced selling, at least not yet from what I've seen. So that's a little bit about what I'm looking at on this thing right here. The other thing that I'm looking for is on volatility. If we look at the VIX, and let's just get the VIX up here. Where are we? Here we go, right here. If you got the VIX up, we're in the yellow zone, right? So you can see here, this is zone 2. So different option strategies play a role when you go from the green zone to the yellow zone, rose to red, and then you got black swan up in this area here, okay? So it's just a little bit of strategy action here. And if we look at the front month versus the back month term structure, even going into Friday, we're just barely in a backwardation mode on the front month. That means the VIX is higher than the front month vol futures. So it means there's still a little bit of near-term fear. If we look at the back month, right, you can see here in the back month, we were in the red briefly on Friday, but we came back and closed in the green. So that means the August vol futures is a little bit lower than the September vol futures. All right, when there's fear in place, the vol term structures reverse, and you see the front month and sometimes even the back month higher than further out months. And that shows you the fear is not just for the near term, but it's going out a little bit deeper, out a couple of months. So I use these term structures to help gauge when we have a little bit of a pullback. Is there really fear, or is it just kind of a let's take some profits off the table kind of thing? So this is just one of the elements that we use. And if we look at the bond market, okay, bonds finished the day up. We went right through my area here, and we came all the way up here to 158.31. My resistance point was right here. I had this on last week. Remember when we were down here, I said, if we break out, we're coming right up to my point. We ran right through it. It's going to serve as kind of like Velcro. It's going to kind of keep the markets up in this area here. And just because it shows a 5 leg here doesn't mean it can't be an extended 5 up even higher. In fact, I saw a lot of market technicians and analysts forecasting rates coming all the way down to 1%. Now, I don't know if I see that, But it depends. I mean, if that happens, it's going to just move the bonds up even higher, and the dollar is going to get stronger too. So we'll see how all of this stuff turns itself out. And looking at the 10-year, you can see the 10-year is now at 2019 lows. It hit a low of 1.842. It closed the week at 185. But I mean, look at that. If I put it on a weekly chart just to show you, when was the last time we were down at this level? And we come all the way back, it comes all the way back here like this, all the way back to November around the Trump election, right around that area there, okay, where we were that low in interest rates. I mean, we've literally fallen. If we come back to the right before the Q4 crush, when the 10-year is at 3.24, folks, that's a huge move. This is a huge vote right here in big money that says further out in time, the markets are just not going to go anywhere. Okay, this is a huge vote that inflation is not going to be present. This is a huge vote that says the signs of a recession and possibly even a bear market because of a recession have gone up dramatically, because the interest rates in the U.S. have moved from 3.25 all the way down to close this week at 1.85. Folks, that's huge. All right, that's over 1.5 percentage points. Huge move. So just keep that in mind. But as we get lower down here, I'm more interested, and I was telling our members here to look at TLT puts, because we've moved way up, and you can see on Friday, or this is a weekly chart, just how fast it moved. And if we take it back down to a daily again, you can see how we moved up in this area here. I would be interested in just picking up a couple of TLT puts. I just think it's going to set itself up to come back down in the value area around 131. Right now it's at 136, but I like that shorting opportunity. It's a contrarian play, but you can just pick up a couple of puts and just consider the cost of the puts as your buy stop or your or sell stop in the thing. So you don't even need to put a stop out there. Go out in time and put it out there and let's see what happens. Now, I may be wrong from a contrarian play perspective, but that would be an interesting play should the markets turn back around again. And of course, if we look at currencies, if we look at the dollar right here, it is moving up. You can see the regression channel on the dollar, right? It's clearly higher highs and higher lows. Once we get, again, I tell all our members this, once we get above the regression channel, look to go long the euro, short the dollar, right? You can do that in the Forex market, or you can go into the futures market and just go short or long the euro, depending on the direction. So right here, this dollar index, once we got up here, it made a new high for 2019. The odds favor it to come back down towards the center line again. When we get down here, you want to go long the dollar. So you can see here, and there is no divergence here. So that does suggest that any pullback is probably going to be bought in the dollar looking out over the remainder part of this year. And of course, if we look at the euro, it's just the opposite. If we look at the euro, here's the regression channel. I mean, we're just coming down. Once you get down to the lower boundary here in the regression channel, be willing to buy the euro. Again, you may be short the euro, but short term, it's a good day trade, or let's say a swing trade to just take it as a counter trend move. So now you can see down here, there are no divergences here. Super Mario Draghi is already on tap to cut rates at their next meeting next month and throw more stimulus out there. And then Queen Bee takes over, I think in October. That's Lagarde, who used to run the IMF. And she's of the similar persuasion as Super Mario. So let's just watch this thing come all the way down. I want it to go down even lower. I'm going to be traveling here, and I want a strong dollar when I travel. So that's a little bit about what we're looking at right here across the currency market. And then, of course, if we look at the metals, gold here, yeah, let's take a look at gold. Gold moving up pretty strong, right? We moved up, made new 2019 highs in gold right here. Once we had this breakout, that was the signal to go long. You can see the value area sitting at 1421. That's where the most volume of bulls and bears were in equilibrium right here, and you can kind of see it. And there's another value area way down here. So there's kind of a dead man space right here. So any pullback is probably going to be stopped around the 1422 area. But we are setting up for a little bit more of a pullback here in gold. Or what you could do is trade a sideways pattern for the near term. Okay. And there's some really great option strategies that we cover in our option masters that 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 covers this. Okay. So that's gold. And then of course, if we look at silver, silver's the same thing. Silver has really moved higher. We were getting long silver on this down move, and I've been long silver for quite some time. And I just think silver has underperformed gold, so hence SLV is a great play to the upside. Okay. And then palladium. Well, palladium, let me find it on here. It's not on here, I don't think, right? I don't think it's on here. So let's just try this. Let me just try to do one of these things here, see if this works. Nah, it won't work. Let's delete that. So we were long palladium, and I think the palladium trade was one where some of our members made a really good amount of money, right? So let me just try it this way. Let's put it on here like this. Put the palladium futures on here. So if we look at palladium, we had this pullback here. We never got the kind of trade that the setup that I was looking for here. We did make a higher high, so that was worth putting a play on, but it wasn't a higher probability trade than this one here, believe it or not, even though it's moved a pretty good distance here over the past few weeks. Okay. Now we're getting into one of these things where any move higher is probably going to be sold off with palladium, but that's been a really interesting trade for a lot of our traders. Also, so now if we come over here and look at GLD, GLD is another one that you can play to the upside. It moves a little bit faster than gold, but here's the value area sitting at 133.61. I think it's probably going to pull back here and consolidate for a bit. So any option strategies that plays a consolidation zone near term should make some sense. Okay, just like that. Of course, if we look at oil, we're sitting right in my value area here in oil. All right, let me just get this off the screen here. Let's do this. Let's come back to here like this. So if we look at oil, remember my value area has been in the mid 50s, right? 54 to 57. You can see a value area sitting here at 58.29. But right in this shaded zone is kind of where I've considered oil to be. But I think oil could move down even more. Okay. We've got a little bit of a kind of a declining head and shoulders pattern here that you know kind of shows itself up a little bit here, and that would suggest. Well, let me get that off the screen. That's kind of crazy, huh? Let's get that off the screen and let's put this one. Let's just do this. But what that means is you've got one of these kind of patterns like this where you've got that, that, and that, right? So that being the left shoulder, this being the head, and this being the right shoulder here. If we break that area, you measure the head to the neckline right here, and that moves you all the way down to these areas down here in the low 50s, low 50, high 40 area if it breaks. And I could see that, and that would only happen if we have a global contagion effect where interest rates go lower, the global markets start to slow down, the S&P pulls back, and we get that kind of worry here. Then I think oil will come right back down to the high 40s. Okay, so I've been neutral to as long as oil is around the mid 50s, I'm okay, but I'm starting to flip the switch a little bit to neutral to bearish in the oil markets. Nat gas, I've liked basically, and you could see we made a new 2019 low here in nat gas, but I like, believe it or not, puts. Bullish puts, so or a bull put spread south of the nat gas price here. I don't think it should go too much lower than this. I think maybe 195, but coming way out down here around 17, 165, selling some bull put spreads in the nat gas futures market to me makes some sense, right? I just think a lot of the drop has been done. A lot of the suppliers of nat gas are closing up their rigs, so that's going to reduce the supply, not to be able, right now there's more supply than demand. They got to close these rigs to balance it all up. But once that happens, I think nat nat gas could find itself back up into this value area here around 2.4 up to as high as 2.5 or 2.6. Okay, so bull put spreads in nat gas make sense to me, or UNG. Okay, now there's a lot of action going in the ag space, meats and softs. I'm not going to go into that. I'm going to save it for our members this Sunday evening in our weekly market watch. If you're not a member of our group, I highly encourage you to come in. A lot of these, especially these directional trades, have just brought a ton of money for our members, especially those that are trading the futures market, and in the commodities market as well. And you don't need to do very many of them to have a really super year. Our option strategies are working out really great. We've got a number of strategies on here that you don't have to worry about the direction of the market. You just adjust the strategy based on what the market's giving you, and it gives you a nice return. Okay. So I'd like to see you guys come on in and join us. We got a pretty good international group of folks in our user group, having a lot of fun with it. Otherwise, members, I will see you this Sunday evening for our weekly market watch. Have a really great weekend, everybody, and I will catch you guys later. Ciao, folks.